Hi, my name is Ben Reppond. Today is March 1, 2022. We'll be talking about the stock market, economic indicators, and I will be sharing with you a special video at the end I think you'll enjoy. As I talk about the market, of course that ties to the Russia-Ukraine situation. It is dominating the media and it is dominating the stock markets around the world. And as I talk about that, it's a little bit difficult because we all see the images of what's going on, the bombing, shellings, etc. by the Russian army, and it's just difficult to think of here's a country and people who are fighting for their lives and fighting for their freedom, and here we are talking about the stock market. I will admit it seems a little weird. But I will do my best. We'll get through it. And I just want you to know that my focus today is not so much on the market, but on that country and those people. And but we will cover the market itself. One of the things that is interesting is the impact on the price of crude oil. Russia is a large producer of oil in the world and exports 4 to 5 million barrels of oil per day and 2 to 3 million barrels per day of refined products. They export that to countries around the world, including China, countries in the European Union, South Korea, India, Japan, and of course the U.S. are its main customers. Our country has committed $310 million to support the Ukraine. At the same time, we turn around and buy 565,000 barrels of oil from Russia every day, helping out Russia. And at $95 per barrel, if we just use that number, that is roughly $375 million per week pumping into Russia's economy. We have to have that oil. I think of the idea, what if we, as a country, and other countries that buy oil from Russia could tighten our belt and not use as much oil or oil products, and we just went into this conservation mode and shut off the supply or the export of oil from Russia, we would crush that nation. We would collectively, that war would end very quickly, in my opinion. Not a war strategist, just thinking. But this is what's going on. This is just a 1 month chart of what's going on with the price of crude oil. This shows the inventories. The inventories are being depleted. You can see an overlay of each of the previous 3 years. And at the bottom of the chart, the lower left, you can see the inventories as of this year. They're being depleted. And because we and other countries are using all that can be, that we can derive from our imports. I want to shift over to supply chain just a little bit. We know that I've reported the rate of inflation is 15% plus. The reported rate of inflation is 7% plus, but the real rate that includes oil, food, and other items that are substituted is actually above 15%. Why do you think when they report this that they exclude food and energy? Because it would push the index up quite a bit. Look at the increase in the cost of 9 grocery components of the grocery index. This has risen actually about 34% since June. And if you go back to April, even more than that. So think of that. If that's an indication of the cost of groceries, cost of food, an increase of over 30%, but yet it's excluded from the consumer price index, which is how we measure inflation. And of course, fuel, oil, gas, is excluded, and look at what's happening to that. Convenient of them to exclude that from the consumer price index / inflation, which is why the real rate of inflation is 15%. So when you hear 7% or rate of inflation today, think in terms of it's 15%. That look on your face when someone tells you you went from $1.86, gas went from $1.86 to $3.79 in 10 months, because the economy is doing better. Thought that said a lot. In the Russian economy, Russia is showing a lot of strength, military strength, as it invades Ukraine and is trying to inhabit the country, consolidate, absorb them into the Russian country. And but when you get behind the scenes, the Russian currency, which is the ruble, is crumbling. It is collapsing. It is the worst currency, or one of the worst, I think it's the worst currency in the world. Now, the US dollar is the reserve currency in the world, so every other currency relates itself, compares itself in a ratio to the US dollar. This shows back to 2014 what has happened to the ruble relative to the US dollar. I think relative to other currencies, it is also crumbling. This shows the emerging markets. Of course, Russia is considered an emerging market. They're a developing country, not a developed country by definition. The first bar shows you the relative strength, the weakness of the ruble relative to the dollar for various developing countries. This shows the magnitude of the impact that the ruble is having. And of course, having a weak currency is not a good thing. It means that you're having to pay more and more for items that you're importing. I saw this headline: Russia to pay for Putin's Ukraine invasion with higher inflation, weaker ruble, and slower growth. Over this weekend, the central bank in Russia raised the interest rates, the central bank rate, the rate that banks charge each other for money, from 9.5%. That's already pretty high. What are we at? 2 or something. They're at 9.5%. It raised it from 9.5% to 20%. 20%. It's costing them. So they have inflation big time. The impact of this cost of money is going to definitely slow the rate of inflation. There's no question about that. But the known consequence of that is it will crush the Russian economy. Anytime you have a rapid change in rates, an increase in rates, you do slow inflation, and you have a seriously negative impact on the economy. So what's going on inside of Russia relative to the ruble, relative to interest rates, inflation, rate of growth, slowing of growth, collapsing of growth, none of it is good. So they know all of this. So as they're invading Ukraine, they certainly want to take over that country, but at the same time, they're a mess internally. We've talked about the inflation going on in Russia. This is a slide of Germany. It's the Producer Price Index, the PPI, and it's an indication of inflation going on in the manufacturing sector in Germany. In particular, and since Germany is the largest economy in Europe, you could say it's an indication of what's going on with inflation in Europe. If you look at, this goes all the way back to the late 70s, you can see the rate of inflation being very low, sometimes negative, and now going from 0 to 25. 25 from 0. Rate of inflation, 25. And that's not the rate of inflation. That is the producer price index. But going from a 0 to a 25. And I couldn't help but think of the Germany post-World War I, when the Weimar Republic in Germany went from a time in 1919 when you could buy with German marks, 14 German marks would buy $1 US. That was the rate of exchange. By the time you got to late 1923, I think it was November of 23, it took 4.2 trillion marks to buy $1. And of course, the German economy, you can imagine what that was like. And in my opinion, that led the way, or sort of ushered in the time that occurred in the 1930s in Germany. And you know what happened from there. This is a supply chain index. It just tracks supply chain issues. If it is positive, moving up, that means that there are supply chain issues. If it's negative, it means there are not supply chain issues, that things are moving very quickly and very smoothly through the supply chain. You can see, and these are standard deviations. So there is a standard deviation of 1 to -1. Normally that is a normal range that you would expect as a standard deviation. When the rate goes above or below that significantly, it shows that you're moving outside of the normal range. In this case, in March of 2020, you can see how high it went to almost 4 standard deviations. In other words, the supply chain was just choked about 2 years ago. And then today, you can see it's gone back up to above 4 standard deviations. That is a long ways outside of the normal range of supply chain issues. We know this because we buy things and we're told, well, they're on back order, and then the word supply chain gets mentioned, and it happens with every time you're trying to buy any good from a retailer, the word supply chain often comes up, and this is why. I'm going to look at the world stock markets. These are 8 different stock markets around the world for the first 7 weeks of 2022, comparing the U.S. stock market to those other markets. Now, we know that our stock market was down for the first 2 months, most of the first 2 months of 2022. Went down around 10%, maybe a little above 10% using the S&P 500 as a measure. The dark blue line at the bottom is the S&P 500 for that 7-week period, and it is overlaid on top of other markets. During that period of time, money left the U.S., the world money left the U.S. and started going into other markets. Some markets did negatively, but not as bad as the U.S., and a couple of them actually were positive for that period of time while the U.S. was significantly negative. Now, that's not a long period of time, that will shift, but I just wanted to contrast that when we had a great stock market in 2021, the markets were up, a lot of money was flowing into the U.S., and the 1st of January, that changed. So this compares it to the BSE Sensex, which is India, Shanghai, the DAX, which is Germany, Hang Seng, Korea, Nikkei, Japan, CAC, France, and the FTSE, which is the UK. So you can see, I won't go through each one of them, but you can see how they did relative to the U.S. market. It's interesting that the world markets are sometimes very different than the U.S. What happened in early 2022 was that the market went down, but not everything went down the same. In the U.S. market and other markets as well, money tends to shift from growth stocks to value stocks. It also shifts from large cap to small cap and the inside sectors that are inside of all that. So there are different ways, but in a macro general way, the U.S. market you could divide into two categories called value and growth. And this chart shows the going way back. This takes us all the way back to 1995, and you can see the periods of time. It's an interesting chart because you can see the periods of time where growth was in favor. That's the blue spikes up above. It goes in favor, and then it becomes a spike, and it goes back out of favor. And then there's a spike at the bottom. The bottom is value. So it goes from growth type companies over to value type companies, and back and forth and back and forth. That's where the money is flowing. Now, when you look at the S&P 500 index, that is comprised of both growth and value. But if you look at, let's say, the Dow Jones, that's primarily a value index. If you look at the NASDAQ 100, that's primarily a growth index. So using those as the extremes, you can see how that shifts. At the very end of the chart, on the far right, you see a spike down, just like all the other spikes. And this is a value spike. In other words, during the first couple of months of 2022, the money, yes, it flowed out of the U.S., which I just covered, and it flowed in general out of the market. But it did not flow out of the value stocks as much as it flowed out of the growth stocks. So value was in favor, relatively speaking, during early 2022, and that's what that chart shows. This is a dashboard that shows 6 major indexes, 4 U.S. indexes, and 2 foreign indexes. The U.S. indexes, these are the red dots, compare the index to its 20, 50, 100, and 200-day moving averages. So you can see that only one of those indexes was positive for those periods of time, the 20, 50, 100, and 200-day periods. And this is as of Friday, and you can see only one of them, the small cap index, the Russell 2000, has started to emerge and become positive above its 20-day moving average. All of the other periods for the Russell and all of the other indexes are all below those averages. So this is a kind of a quick snapshot. It's a dashboard to show what is the direction of the market. Right now, the direction is negative. There will be periods, short periods of time, where we will go positive. It is entirely possible with this much red ink that we could go on down further. We're kind of at an inflection point. Either we go down further or we go back up from here. I'm not going to speculate as to what direction it's going, but I can tell you that during this last couple of month period, it has definitely been negative, and some of the indexes were negative prior to the 1st of January. When we look, the bottom 2 numbers are the foreign indexes. EFA is the developed countries like Europe, or UK, Europe, Japan, South Korea. Those are developed countries, and they comprise the EFA index. They're all negative. The EEM is the emerging markets, and it is negative for all of those same periods. You'd say this was basically a negative chart. It can change, so we can observe that if it changes, but for now, primarily they are negative, and you probably know that over the past couple of months. Now I'm going to look, this is the S&P 500. It's represented by the exchange traded fund, SPY, SPY, and this is a weekly chart. So each move on the chart is representative of 1 week for the past year. And this shows that, and then I put a 20 period moving average on here, which means a 20 week moving average. So you can see that the S&P 500 has broken its trend line, the upward trend line, and it has broken below its 20 period moving average when looking at it from a weekly perspective. Now I'm going to compare the S&P. This is a comparison chart. I do a ratio of the growth stock index, VUG, which is the Vanguard Growth Index, compared to SPY as the denominator. So that ratio tells you how are growth stocks doing relative to the S&P 500, and you can see they are below the line and they're above the line. It's a daily chart, it's a weekly chart, and it goes back over the past year. You can see for the past 4 months that growth stocks have been weaker than the S&P 500 itself. And then they broke below the moving average, the 20 period moving average, and right now they are way below the 20 period moving average. Relative growth versus S&P, which is growth and value. This is a small cap index. Now remember, the small cap index on that dashboard was the one dot that was green. The one dot that was green is that this has moved above its 20-day moving average on the daily chart. Now this is a weekly chart. So you can see the tick up at the end, if you put this on a daily chart, has moved above its 20-day moving average, but is still below the 50, 100, and 200 day moving averages. But small cap stocks, look at where they have been for the past 11 months. They have been declining relative to the S&P 500 in a declining mode. Now, that will change at some point, but that has been for some time the weakest index in the U.S. market. This is, now we're going to shift away from equities, stocks, and stock indexes over to bonds. This is a 24-month chart, not a 12-month chart, and it illustrates the exchange traded fund, TLT, which is the long-term government bond ETF. And you can see there are 2 periods of time, one in 2021 and one in 2022. Look how negative that is. Now, this is significant because government bonds in general, whether it's the intermediate term, short term, long term bonds, are used as a counterbalance for stocks in portfolios. There are other bond funds or ETFs that are used, but the government bonds are primarily used because they tend to be non-correlated with equities. At least they have been for the last 40 years. So when you see this, this is an indication that yes, equities declined. I'm looking at the far right of the chart. They declined for the last couple of months, but so did bonds. So the traditional portfolio that says put bonds together with stocks, if you happen to be in an allocated portfolio that has stocks or stock funds and bond funds in it, you have probably noticed the abysmal rate of return or lack thereof going on in your portfolio. And it's because this is what's happening. As interest rates go up, bond yields go up, and as bond yields go up, the price of those bond funds comes down. and many experts, I won't go through them now, are saying we're headed for a multi-decade period of time where bonds will collapse. They will decline in value, and I think the traditional method of investing is already out of favor and is going to become even more so. This chart makes my point. I'm going to shift over. Asbury Research provides a dashboard that shows the sectors in the economy. The sectors, and this relates to not performance or price, but relates to asset flows. Where are asset flows? Where's the money going? The money is going into certain sectors and out of certain sectors. And it's a little bit of a mixed bag. The only one that is consistent is consumer discretionary. That shows that for the weekly period, last week, the last month, and the last quarter, that the flow of money is out of consumer discretionary. This last week, the flow of money came out of financials, and it had been favorable to financials before that. And what is now in favor, based on the last week, is healthcare and technology. Asbury also does a cross-asset relative performance to different types of assets. And there are 3 of them that have consistency in all 3 periods, the weekly, the monthly, and the quarterly. Those are the high beta stocks, high volatility, compared to low volatility. In all cases, performance was actually better with high beta stocks in all 3 of those periods. It doesn't mean that it was positive, it just means it was positive relative to low volatility stocks. High yield versus corporate bonds. In all cases, high yield declined, but it declined less than corporate bonds did. And short-term versus long-term bond prices, in all cases, short-term bonds perform better. The reason for that is that in a declining, let's say a declining bond market, which we've been in, the long-term bond is going to exaggerate that decline more than the short-term bond. And in a rising market, rising bond market, the long-term bond is going to exaggerate the upside and is probably going to outperform the short-term bond. But since it's a declining bond market, it's no surprise that the short-term bonds are performing better than long-term bonds. The United States versus the world, also from Asbury Research, they look at this from a weekly, a monthly, and a quarterly perspective. And you know I provide this to you on an ongoing basis. Isn't this interesting? Last week, this chart was filled with other countries. And in 1 week, there has been a shift of money coming into and performance into the U.S. relative to all of these countries. And some of them are regions and some are countries. In every single case, the U.S., we have our problems, and the stock market has not been wonderful, but relative to all these other countries, for the last week, we outperformed every one of them. On a monthly basis, it's mixed. Some have outperformed the U.S., and in some cases, the U.S. has outperformed. And the same thing on the quarterly, and you can see those countries. I won't go through each one of them. Gold and silver. As of this morning, first thing this morning, I took these prices, and this was, the gold was $1,890 per ounce. Which is up 0.8%. Silver, $24.56, up 2.5% over a week ago. And I provide some resources. This is a chart showing what has happened up until February 24th. So this data is about a week old. The in the last couple of days of last week, I think this has been somewhat positive, moved back into positive direction. But you can see over this period of time that from January 24th to February 24th, Bitcoin and Ethereum went up and collapsed. And it's a roller coaster ride. And you know I'm no fan of Bitcoin, but that's the roller coaster ride that Bitcoin takes people on. They get excited and then they buy and then it collapses. This is not a long chart. This goes back to November 7. So from November 7 to today, you can see the direction of Bitcoin. It's generally negative, but I think more importantly, the point I would make is that Bitcoin tends to suck people in at higher prices and then it collapses, and it happens over and over again. Moving over, conversely, this is again just a 1 month chart. You saw what happened to Ethereum and Bitcoin, up and then collapsed. The opposite happened with precious metals. This looks at gold, platinum, and palladium. We don't typically look at platinum and palladium. They're more volatile than gold and silver, but palladium certainly has been on a tear lately, and so has platinum. Gold, but less so. So you can see the direction that they've gone up just in the last month. So as equities and many assets, bonds, have been collapsing, the precious metals are having their day in the sun. I got an email from one of our viewers and with a very good question, and I wanted to share it with you because it may be on your mind as well. You have money invested in the market and you have a portfolio doing whatever you're doing with that. You also probably have money in the bank. And so I hear this question as more oriented to the money I have in the bank is losing value every day. Every day it's going down because inflation is eroding the buying power of the dollar. So his question was, should I be buying TIPS? What that is it's an acronym for Treasury Inflation Protected Securities. It's a bond type instrument. And it was developed in 2004, and the idea was to provide a vehicle where people could buy this TIP ETF and have a degree of protection from inflation. Of course, this was during a period of low inflation when it was introduced. And so I went back and measured the value of the ETF TIP from beginning to today. The average, it has some volatility, but it's not horrible. The average rate of return for the exchange traded fund TIP from inception to today is an average annual rate of 1.25%. Inflation is at 15. So whether you use the 7% number or the 15 number, why do you want to do that? Inflation has gone very high very quickly in the last 6 months. And so I went back and I measured during this period of highest inflation, the highest since 1981 that we've experienced. How did it do then? So measuring the last 6 months, the direction was negative. It went down during a period when it is supposed to go up and protect against the inflation. So I would say the answer to that question is definitely I would not buy TIPS or TIP exchange traded fund. And that includes dividends. If you use Yahoo to search, Yahoo's charts do not include dividends. So I went to a software that I use that does include dividends, giving it all the benefit of the doubt I could possibly find, and that's what I got. And they tend to be correlated much of the time with government bonds, and I've already covered what's going on with government bonds, and that probably accounts for the fact that the return on TIP was negative for the last 6 months. This is a slide that I've shown you before. This is the relationship between bond yields and bond prices. Now, this is a very important slide, and I put some arrows on here to make this point. I'll explain why I say it's important. It's a macro chart. So if you looked to the left, you see that I put a green arrow going up to the upper right. That represents a period of time of 1946 to 1981, a 35-year period of time where interest rates, or I should say bond yields, went from 2%, about 2%, up to a high in 1981 of 15%. Corresponding to that period, look at the red arrow on the left going down, and you see that bond prices, today we say bond fund prices, but bond prices also, were declining, I would say collapsing, during that period of time. 35 years. Then, in 1981, it changed. You see how it goes in these cycles? It changed so that the green arrow went down from 15% yield on bonds all the way down to 2%, right back where they started 75 years ago. Corresponding to that, bond prices went up. The red arrow on the right side, the bond prices went up. They are inversely correlated. The yield goes down, price goes up, and vice versa. What's significant about this is that the traditional financial advisor model for investors typically includes bonds/bond funds, and usually a lot of those are government bonds. Financial advisors have come into the industry and been educated, most of them, in the last 40 years. During that period of time, it has been true that bond fund prices have gone up, and they are, most of the time, I think about 70% of the time, inversely correlated with stocks. When stocks need help, they go down, bond prices tend to go up. They've stabilized the price on bonds. That's been helpful because in general, the bond prices are rising. So even though a bond fund might go down, it doesn't go down long term. Long term, it still goes up. So this tool has been helpful for the last 40 years as a counterbalance to stocks. But think about this. What happened is interest rates went down to zero and bond yields went all the way down to their bottom, which was 2%. Where do they have to go from here? I say they have nowhere to go but up. And repeating a period of time, I believe, that goes back to 1946, where we are in a period of rising interest rates, rising bond yields, and falling bond and bond fund prices. I mean government bonds. And we've seen this by looking at the previous charts I've shown you on bond funds of how poorly they have done during this recent period. I think this foreshadows what is to come, which is a very bad period. Now, for investors, I hope I don't step on your toes, for investors who are invested in stocks or stock funds and bonds and bond funds, this is not good news. They are becoming correlated. There will be short periods of time where bond funds will go up. I know that. But long term, when you look over the next 10 to 15 to 20 years, maybe more, I believe we're going to be in a period of rising interest rates and a period of falling bond and bond fund prices. The traditional model, the traditional advisor that uses this does not have an answer for this problem. They are locked into their model and to their thinking that bonds and bond funds are the antidote to equity risk. While it has been true for 40 years, I think we're in a new environment, as the far right of the chart shows you what direction we are likely to be headed in going forward. Now I want to show you, I'm going to end this with a video. I recommend you watch it. It does last 5 minutes, but I think it's a valuable 5 minutes out of your life to watch this. It's not about, by the way, it's not about investing or the economy. It's about people. I saw it, was sent to me by my former business partner. He and I owned a couple of companies in Seattle, and over a period of about 20 years. And after we sold those companies, we both moved on. And so I appreciate getting it, and thank you, Lou, for sending it to me if you're watching. And I'm going to share it with the audience. This is an interesting and, in my opinion, a powerful video. The world is full of negative news and sometimes our lives are full of or have elements of sadness or depressing news, and sometimes there are some positive things that we can look at that are positive, that are going on in the world, and sometimes we can take lessons from those of how can I change, how can I be a more positive person, and what can I do in my world. And this video shows you that. It will end, and that will end the broadcast. But thank you for taking the next 5 minutes to watch this video.
It started a year ago. They came blowing in, gliding around the bend, a big old rolling party in a '69 Cadillac DeVille, extravagant, carefree, happy.
We made the conscious decision we were going to make the most out of life because we didn't know how many days left and if we could wait COVID out.
I would get down in the dumps and he'd go, get out the Cadillac, dress up, date, get in the car.
They flowed into Blue Water Bistro in Leschi, where Bart Evans is the owner.
When the full shutdown started, just we're driving around the lake looking for any restaurant open and just kind of stumbled upon our car hop service.
And they kind of took that to a whole new level.
Carmen Bader works there too.
We don't know. We just got lucky. They picked us. They've stuck with us throughout the pandemic.
They'd get champagne or wine delivered to their car.
To another great adventure.
They'd order lunch, and they kept coming, over and over again.
All right, thank you. You're so welcome. Appreciate it.
They're here 3 to 5 times a week. They become like family.
And then oftentimes, they'd get out of the car, always dressed to the nines. Just ask Blue Water waitress Frances Martin.
Honestly, it's just like happiness. It's like a ray of sunshine. They come in, they're smiling, they're dressed up.
And they'd play some music on a speaker. And then right there in the parking lot, Dennis and Linda Sheets would dance. Irresistibly, unapologetically, Linda and Dennis always put on a show. They are an event.
They literally light the room up. There's no other way to say it, as corny as it sounds. They light the room up.
Day after day, month after month, they showed up to support Blue Water Bistro in a trying time. Each time dressed up, each time happy and meeting people, and always ready to sway in one another's arms in the parking lot ballroom.
And then they would have a dance party in the parking lot here on the pier and do the waltz and the foxtrot, and you know, the world was consumed by fear at that moment, so it brought this levity, this joy, and it was just rather profound.
On one beautiful day, for the occasion of Dennis and Linda's 100th trip to Blue Water in 11 months, there was something special waiting for them, a party.
They told us that Dennis and Linda were going to be here, so I knew I needed to bring my fancy clothes.
A band called the Swing Beats was brought in from Vegas to perform on the bed of a truck.
Fly me to the moon, let me play among the stars.
A little romance, some glamour, right there on the lake, right when we needed it the most.
In other words, hold my hand.
It was a challenging year. There's no doubt about that.
Yep. But you got to make the best of it. The best of every single day.
Some kids ran up because they couldn't resist the scene, and it didn't take long for Linda and Dennis to charm them the way they charm everybody.
Oh yeah, everybody loves somebody.
But there's something the king and queen of Blue Water Bistro didn't talk about that day at the party, something that explains it all. The clothes, the zest for life, the urgency with which they seek joy.
I'm stage 4 metastatic breast cancer. I was diagnosed just before COVID hit.
She says it's terminal. She's getting chemo, fighting for her life.
My last heart attack, they called it the Widowmaker.
And Dennis, well, Dennis has a bad ticker.
A very small percentage of people survived that, but I did.
A really bad ticker.
Waiting to get on the heart transplant list. And I'm not excited about it, but if it happens, it happens.
They know that tomorrow isn't promised to them or anyone else, but they also know that today can be fantastic.
Live every moment. Get out of your pajamas. Put on a lovely outfit or a gown.
We take every day and make the best of it.
And when they're done with their dancing and bedazzlement, they climb back into the 69 Caddy DeVille and drive away in the breeze to go wherever it is that they fight their private battles against the frailty of the human body, having just taught all of us a very public lesson about the resilience of the human spirit.